morning, Amanda.
Good morning, Simon. How are you?
Very well today. And how are you?
Yeah, we're all right. We're surviving the cold snap, as it were.
And who is our special guest today?
Today we've got Katherine Bullock, who is at Field Tax Chambers and has a eye-watering array of knowledge in relation to all matters tax that would be particularly of interest to our client base and listeners. And today she's going to discuss with us the pros and cons and pitfalls of partnership to incorporations, and maybe touching on a little bit of business property relief on the way. So good morning, Katherine.
Hi, Simon. Hi, Amanda. It's lovely to be here today.
So give us some background on you and how you've come to this point.
Like you said, I'm a barrister at Field Court Tax Chambers. I've been a tax advisor for about 30 years now. I was a partner with two of the big four professional service firms. So I looked after the UK private client business for one and the EMEA private client business for another. And I guess throughout all the time I've been acting for clients, properties always seem to be a really big feature of the work they do. So advised on that a lot. And now I am the editor for Gami and D'Souza on land taxation. So there's sort of a strong land theme running through most of what I do.
True that you ran the biggest private client practice in the UK?
Yes, that's right. That's right.
Mightily impressive.
It's a little like herding cats.
Okay, so shall we get on to incorporation of a property business, what it generally is, what's involved, any scare stories are always very popular with listeners. Over to you.
Okay then. I think these two areas we're going to talk about, incorporating a property partnership and business property relief, got a lot in common really, in that they both involve businesses and how you define a business, which I think is probably the big opportunity and the big trap. And both are pretty popular at the moment. I don't know what you're finding, but I'm finding a lot of people are interested, particularly with expected changes coming up in the budget and possible increases to tax rates. So I thought if I start for a few minutes just talking about incorporating a property partnership.
Lovely.
And I guess there's quite a few reasons why people might want to do that. There are some pretty sound commercial reasons. You know, they want limited liability, it's easier to get finance, succession planning. On the tax side, I think people are usually looking for things like a lower rate of tax, so corporation tax rates being lower than income tax rates. The possibility of getting a tax deduction for interest now in a company, which you can't as an individual. And I guess perhaps potentially the fact that capital gains tax might go up and be aligned with income tax rates, whereas corporation tax rates will be relatively low. The real challenge is around how do you go about incorporating your property business? Because if you do it incorrectly, there can be a staggering amount of tax to pay. You can end up with capital gains tax at 28%. You can end up with SDLT at up to 15%.
That's interesting, Katherine, because one of the things that we have we've found is that I think is that there's been quite a lot of one size fits all popping up on the internet, and sometimes it's very difficult to explain to a client that one size definitely doesn't fit all, and that you really need to be very mindful of the steps that you're taking lest you fall into those quite expensive traps.
Yes, I think that's right. I think the problem is that the headlines can be very attractive, can't they?
Yeah.
And you hear a lot of people, I think this is something people talk about a lot to each other. And it sounds like, I just do this for a couple of years and then I'll be able to do that and there'll be no tax to pay. Whereas actually, you really need to think carefully about the steps and work out what is best for you and your business and your family, and do the calculations each time. And yes, for quite a few businesses, incorporation may be the right answer. But for others, it isn't. And there are alternatives that are actually quite interesting rather than, as you say, this one size fits all.
Yeah.
I think the big challenge for a lot of people is whether or not there actually is a business to incorporate there at all. If you basically are, say, husband and wife with one property that you're letting out and you're relatively passive in what you do, then I think there is a high probability that the Inland Revenue are going to look at that and say, no, that isn't a business. That is simply a joint investment in land, and you're not going to benefit from any of these reliefs. So yeah, it's really a case of examining the facts really carefully, I think.
And in terms of the activity, so as you mentioned, just sort of a passive investment effectively, and you're benefiting from the income that drips into your account on a monthly basis. I think there's quite a lot of relevance and importance attached to the fact that you're involved in that business in some way.
Yes, that's right. There was a really useful case, the Ramsey case in about 2013, where the tribunal set out some helpful guidance on what's required. And one of the key factors there was that there was sufficient activity. And in that case, it was 20 hours. So the lady spent 20 hours on her property letting business. And the revenue manuals have picked that up. And they basically say that if you have an individual undertaking 20 hours of activity on their property letting business, they will accept that as a business. 20 hours, it's not hard and fast, but it's a good indicator of the kind of level of activity you want.
What do they define activity? How do they view the activity?
It's interesting. I think this is where you've got some sort of confusion perhaps between what you're looking for business property relief and what you're looking for incorporation relief. When we're talking about incorporating, we're not really talking about the quality of the activity. So we're not looking for someone who's doing over and above what you would normally expect a property letting landlord to do. We're really interested in the quantity. So are they putting in enough hours and enough work for the number of properties that they look after?
Right.
And I think also it's important to appreciate that property businesses fluctuate. So you can have periods where you have an awful lot of activity. You're changing tenants, you're doing up properties, you're sorting things out on a particular let. And then you can have periods of inactivity because all of that's done and it's relatively passive. And I think that's in the nature of a property business. So not to be too put off by that fluctuation.
Because in Ramsey, I think she used to oil the garage doors, take away the rubbish, meet the tenants. She was very actively involved. I think it was a 10-bedroom HMO, I think in Glasgow, I think somewhere. So she was very active in managing that property.
And the more of that kind of activity you've got, that the better your case will be. Yeah. I think also things like having a really sound business plan, understanding how the business is going to work. I think that is also very important.
Right.
Because a lot of clients who have quite large portfolios, but they farm out the management side of it. So in effect, they really have no involvement in that portfolio because it's dealt with by an agent.
Yes, it's interesting, the agency point, isn't it?
Yeah.
And whether or not an agent doing the work for you would count as you doing the work. I think generally I think the revenue are looking for you to be doing the work yourself on your portfolio, and that's definitely
I think in a Ramsey case, the manual, it just says that if you are personally managing the portfolio, so I think they're quite kind of keen on that as well. And also, of course, I think it says as a going concern. So maybe even if you are managing the portfolio, but you're making losses, is it a going concern?
Yes, I think that's a good point. This point around whether you've transferred the business as a going concern. I think you need to be careful there with, whether you've hampered the company afterwards. If you've entered into contracts that restrict what the company can do afterwards, has it actually taken on a business that it can run as a going concern, its own business? Or is it so stifled that it can't? And similarly, if you're going to do a reorganization afterwards, say you've got your business in a company and now you want to move it around in different subsidiaries or something, I think preserving that business and just making sure that it makes that transition smoothly is another point that people often miss.
Yeah.
So just for clarification as well, you could have one property that has 10 HMOs, and that could be sufficient to be classed as a business. So it's not the number of properties, is it the number of units within that property or the amount of time that you're spending?
It all comes down to the particular facts. I think you're right. One property with a lot of units is just the same as having many properties.
Yeah.
But the more properties you have, the more units you're managing, the more tenants you need to look after, the
better.
more it's going to look. Yes.
Yeah.
I think it's a question of the facts, but also how those facts can be presented.
Yeah, it's
to
never
create that impression.
It depends on a case-by-case basis.
Yes.
And obviously, the Ramsey case is, I view it as guidance. It's a good indicator. It's a good yardstick. But you can do less hours, maybe, or even more hours. It's never kind of. If you don't fit into that kind of Ramsey case, you can still qualify.
I think that's right. It's almost like there's a case, isn't there? And then people try to do everything they can to match it as much as possible.
They try to horn you into that kind of,
yeah.
You must do 20 hours, Mrs. Ramsey. You know, it's one case on a very big issue.
That's right. I only did 19, so there's no point my trying. Or yeah, get out and oil those garage doors. That's what I say.
Oh dear. So we've digressed. So we feel that we might qualify as a business, and then
yes.
we take it from there.
Yes. So I think if you're comfortable that you have a business and you fulfill those conditions, then you're going to qualify for the capital gains tax relief, which means that you can transfer the business to the company without a capital gains tax liability. The advantage of having a partnership is that the way the partnership rules work, there's a possibility, if the conditions are met, that you will also be able to do that transfer without SDLT liability. Now, for that to apply, you essentially need to have a partnership of individuals who are closely connected. So typically you'd have close family members, so a husband and wife, say, in partnership. And then they incorporate into a company where they will both be shareholders. And because you have individuals who are connected to each other and connected to the company, the way the SDLT rules work is that there will be no SDLT liability on that transfer.
And I guess crucially as well, the shares that or the percentages that they held the partnership in must also be reflected in the company shares. So if they were 50-50 partners in the partnership, they become 50-50 partners, 50-50 shareholders in the company.
You would normally expect that to happen, but I think the important thing is that they're connected so that you're looking at their interests as a whole.
Right.
If you have so essentially in I think to get the 0% relief, we need everybody connected to each other and connected to the company at the end.
Yeah.
I think the attraction of that relief is perhaps the point that that is causing people to sort of think about how they structure their businesses before they incorporate, and perhaps is leading to an area of difficulty, because people become aware that there's this relief and they think, well, if I had a partnership, that would be really handy because then I could incorporate it and avoid SDLT. How can I get a partnership? And how long do I have to wait before I can incorporate?
Yeah.
And the difficulty is, and I know you've talked about this quite a bit before on the podcast already, but the stamp duty land tax legislation has really nasty anti-avoidance provisions embedded in it, which essentially say, regardless of what your motive is, if you take steps that avoid SDLT, then there will be an SDLT charge imposed upon you. So artificially creating a partnership in order to be able to incorporate without SDLT is likely to walk you into those anti-avoidance provisions.
It needs to be a genuine partnership, genuinely run as a going concern, as a business, because I've just written an article for Tax Advisor, which is going to be in the March issue on this issue, but also on on paragraph 17A.
Yes.
So there's also a thing that, because one of the things that is I find annoying on social media is there's this kind of this idea that you cannot incorporate, you have to wait 3 years, and of course the 3-year rule is within paragraph 17A and the anti-avoidance rule. But there is no safe period, of course, but it needs to be a reasonable, sensible time from the partnership creation to when you incorporate. It can't, of course, a month or 2 months. It needs to be some sensible time frame.
Yes, I think that's right. I mean, essentially, you need to have a proper partnership, don't you?
Yeah.
If you've entered into a partnership and you operate that partnership correctly, and you are genuinely in partnership, and you have those things that support it, like a partnership agreement, that the property's properly held as a partnership asset, that you both share, or however many partners share in the income and the capital, you know, your bank account and your partnership name, and you return that to the revenue, and they know that that's what you're doing, and they haven't raised any questions, and then you incorporate, it seems to me that you've done all of the right things.
Yeah.
I think you're right. There was a sort of fashion, wasn't there, of telling everybody you could do this, and then there was a fashion of telling everybody you can't do it.
Yeah. I think confusion. I mean, obviously, we do meet a lot of clients who normally husband and wives or family members who own property jointly, but that's not a partnership, as we tell them. It needs to be formally recognised, register it with HMRC, file a return every year. There's that misconception that because you hold something 50-50, it's a partnership.
Yeah, if you look at the Partnership Act, I think Section 1 says a partnership is undertaking a business together for profit. And Section 2 essentially says that owning property jointly doesn't necessarily create a partnership. And then it lists off all the different ways, doesn't it? You know, tenants in common, joint tenants.
Yeah.
You know, anything else you could possibly think of, guys, we want to make it absolutely clear that jointly owning property isn't in itself enough. Yeah. It's a very, very rough paraphrase of Section 2.
So here's a tricky question for you. So what would you say is a reasonable period? Would you say that it's a reasonable period before you incorporate, or would you say it's more really based on the individual activity, how it is run, as opposed to a year and a half, or 2 years, or?
I think it's the former. I think it's having the partnership properly run that is the main thing. But I generally feel comfortable if somebody's operated a partnership for at least 2 years,
yeah,
and uncomfortable if it's shorter. It just doesn't feel like enough time to,
that's inflammatory, I suppose,
to be able to demonstrate those facts.
Yeah.
But I think your point about 3 years is a good point and an interesting one.
Because we have a client, well, not a client, it was a prospect who I met last year. And she asked me to give her advice on this point. So I gave her advice on the point, paragraph 17A. And unbeknownst to me, she got other advice also from an editor of a stamp duty manual, and our advice matched up. But I keep bumping into her on various forums, property forums. Now we have the same conversation, and she's no further forward. She has in her head, she has this, I have to wait for 3 years. And I say, well, no, you've got my advice says no. You've got the advice from Mr. So-and-so says no. It's quite clear anyway on I think on the Office of Tax Simplification, I think they did an article in 2014 saying this rule is pretty much obsolete now. But
yes,
I can't get her over that 3-year hurdle. She just will not listen. Very annoying.
I suppose the time is ticking. So
eventually you'll get there. Yeah.
But it's even though she acknowledged that her advisors then, who she stayed with, advised her incorrectly, she will not move forward on this point, and I find it quite frustrating. Anyway.
Yeah, there we go. So how are things differing then with business property relief?
I think with business property relief, so business property relief, we're going to obtain if we have a business or we have a company carrying on a business. But there we have a negative test, really. So to qualify, the business needs to be one that is not dealing in shares and securities, dealing in land and buildings, or, let me get the test right, wholly or mainly making or holding investments. So what we're trying to show is that we don't have an investment business. And where you can get muddled up, and where the courts have said people get muddled up, is they look at the tests like the one we've been talking about for Ramsey, and they think, oh, if we apply that to our letting business, we will definitely have a business for business property relief purposes. And the tests aren't the same. What makes you a property business that qualifies for one test doesn't stop you from being a business that is making or holding investments for another test. Does that make sense, sort of?
Yeah.
Perhaps.
So simply holding, whether it's 4 HMOs or 25 properties, from which you generate a rental income, just simply going and oiling the locks and chatting to the tenants, although will demonstrate your a business in terms of, if you was in a partnership that you'd want to incorporate, in terms of claiming business property relief, you are actually holding those properties as investments that generate an income for you, and don't qualify in terms of business property relief requirements.
That's right. Yes. So investment for business property relief purposes doesn't have to be purely passive. You can still be doing things in order to keep your investment ticking over. But if what you're doing is simply holding land to generate an income for yourself, then you aren't going to qualify for business property relief. Mm-hmm. And the cases use a spectrum. So they sort of have at one end, very passive, I just hold a property, I collect the rent. And at the other end, they have hotels and bed and breakfasts that will qualify. But the level of services that they're looking for people to provide in order to qualify is a very high hurdle.
I've got a case at the moment that I may be told to advise upon, and it is a gentleman who died last year, but it's service accommodation, so they have a large property in West London. It's been run as a partnership for I think 35 years. And they qualified as for BPR relief back in 1986. So they have all the old letters that you used to type out for HMRC in the old days. They have all of that, and they have advice, I think, for a couple of years ago, where they, from a different firm, confirming that, in their opinion, it would qualify for BPR. So I may get that work to do, but it's quite interesting because it's not a hotel as such. They don't provide the high level of service you would expect from a hotel. They're kind of in between. And I was trying to say that obviously BPR relief, it's purely going to be on the date of death, a snapshot. Does it qualify on the date of death?
Yes.
And do you have diaries? Do you have evidence of what you actually manage, what services you provide, how you advertise it, all these things? So hopefully I'll find out today. I forget that work to do anyway. So
I think that's interesting, isn't it? Because you're right. When you look at business property relief, it's that snapshot at the point, isn't it? The point somebody dies, or the point they make a gift, and exactly what happened at that point. And looking back might help you interpret it, but it's very much that point. And to some extent, it's almost like a self-fulfilling prophecy, isn't it? I was thinking about this the other day. You go along, you take advice, and somebody says you do or don't qualify for business property relief. That then may have impact on what you do for the next few years. You might think, oh no, I'm going to have this tax to pay, so I ought to make sure I hold cash available to pay it, or whatever. And then when you come to take that snapshot, in some ways it's sort of predetermined how the relief works, if you see what I mean. It's
quite unfair, because as I said in my email to the lawyer last night, I said, just because she qualified, or think you qualified in 1986, or you qualified 2 years ago, doesn't mean you qualify when he died. It's good, it has to be at that time. So obviously, well, I'll find out if I get instructed and get more details, but it's quite a good case, I think.
It sounds like an interesting one.
Because it's such a worthy relief to be able to claim.
Yes, I mean it's an amazingly generous relief, isn't it? You know, effectively to reduce the value of whatever you've transferred by 100%. You know, is an incredible thing, and it's whether you're dealing with an offshore business or an onshore business, you don't have to claim it. The revenue will give you clearance on it in advance. It's a fabulous relief if you qualify for it.
It's immensely valuable. We've seen quite a few cases where people that are not being advised on it, or they just seem to ignore it, which to me is just crazy.
I think particularly with property businesses, it's perhaps not so well understood, because there's this assumption that either you'll be dealing in land and buildings, or that you're holding an investment, and so perhaps it's something that people don't look at or don't consider in sufficient detail.
Yeah, well, like I say, it's looking at it in the whole as such, because you can have I think is it farmer versus farmer case, where there was a Mr. Farmer, the inspector, and there was a farmer who was a farmer who renovated, I think, some outbuildings to supplement the income of the farm. That was really looking at the whole, the income, the capital value, the activity, and everything. So,
yeah, I think looking at it in the round, and it's a all or nothing relief as well, isn't it? You know, if you're wholly and mainly, so broadly 51% meeting the conditions, you're getting relief on the whole of the asset. If you don't get any relief. So it's, you know, it's quite a sort of sharp edge. But I had an interesting case of a little while ago concerning a sort of a farm with lots of different mixed activities that was right on that cusp of the 51%. But because we could show that all of the activities were tied in together, so that, you know, the houses had to be let because the let income supported the farm and the farm shop and all of the other parts that went together. We were able to get relief on the whole thing, which was really interesting.
So from that perspective, if you had a mix of properties, some of them you let out and some of them you develop and move along and flip and sell on again. So what you're saying is, with all of that group, provided you could show that 51% of your activity is mostly in terms of the trading activity rather than the investment, you would probably qualify on the whole lot?
I think it depends exactly what you've got. You need to analyse it to start with, because if those properties that you had retained were still within your stock, for example, because you were just holding on to them to do more development, they might not actually be investments at all, in which case you wouldn't need to worry about it. But yes, if you had some investment activity, but predominantly your business was a property development business, so that if you looked at it in the whole, in the round, it was a composite business of property development, then I think you could argue that you should qualify for relief there. It's always grey with land. You know, what is dealing in land, what is developing land, what is investing. So, you know, a bit like we were talking about before, it really does turn on the facts and having as much evidence as you possibly can of what those facts are.
Yeah.
It seems to be quite a common question now anyway. Obviously, incorporation is quite relevant at the moment. We'll find out what the change will be to capital gains tax, whether we'll align it or not with income tax, or whether obviously they're ignoring gains in companies and trusts, so it's not really a total review of capital gains tax in HMRC's normal way. But we seem to be getting more inquiries now that to do with BPR. So people are looking into it more. And we had an inquiry probably a month ago where a lady was a developer. She used to make massive renovations to property that she used to buy, bring it back to the brickwork, redesign it, do her own architect drawings. She was very much a developer. And then for whatever reason, I think it was family reasons, she then held on to 2 or 3 properties for 4 or 5 years. I think Patrick Sauce calls them kind of slow moving stock, I think she believes. But there's that kind of grey area. And then towards the back end of her life, she was again knocking down walls and developing again. But their current advisors really did a one-page letter on that saying you don't qualify. They never really looked into that issue at all.
Yeah.
And it was like a few £1 million worth of tax that was at stake here. And then we just highlighted the issues, why you're not looking at this point, and so on in the meeting. And then they went away and appointed somebody else. Even though we kind of pointed out the idea in the first place. But,
And this just shows that in England, we just prefer the gloomy outlook.
no,
What do you think?
Again, I don't know. I'm not one to hold grudges, but then
Yeah, but I think you're right, and I think that's a really good description. You know, slow moving stock. It's important to understand exactly what you have, because the relief is a really valuable one. I expect at the moment there's a lot of speculation as well about, you know, will BPR survive? Are we going to see changes to inheritance tax? Will we see a new wealth tax? So people looking to perhaps preserve the relief if they can by, you know, maybe transferring assets into trust or giving them away, those kind of things.
Indeed. Do you have any scare stories? Any things that you found where things weren't done correctly, or the incorporations weren't really, or that they did the incorporation, but it was found after HMRC scrutiny that it wasn't a business in the first place?
I don't have scare stories like that. I've come across people who are concerned that those things might happen. And certainly where I think you have to be prepared for the revenue to take a really good look at things and how they are working, and the level of inquiry can be quite worrying.
Yeah.
I think it's a case of if you do things carefully and you are prepared to fight your corner, then on the whole it comes right in my experience.
At the end of the day, you have to expect anyway, under the system we're working now, with self-assessment, that HMRC can inquire, and it is within their right to inquire into a return where you've disposed of your assets on an incorporation and claimed a relief.
Yes, and I think that's again looking at the two reliefs we're talking about. That's one of the shames on the incorporation side, isn't it? That in the past you could go for clearance. So you'd write to the revenue, say, this is what I'm going to do. The revenue would write back and say, yes, we agree. And then you were okay to go ahead.
Yeah.
We still have that possibility on business property relief, which I think is perhaps sort of underutilized.
Yeah. There we go. Cool. Well, that's really good. Amanda, anything other you'd like to add, or?
No, I think it's so interesting, and I think it's so important, as Katherine said, in terms of the nuances of slight differences between everything. And I think it just comes back to what we said at the very beginning. It's important not to think that you can shoehorn yourself into 10 steps to glory and that you'll claim all of these reliefs and all will be well in your world. So I think it's just really important, you know, that Katherine's reiterated the facts of each individual clients are so important to review and consider, and to make sure that the steps that you're taking very much fit in with your own personal circumstances, rather than thinking that, you know, it's a situation that's open to everybody and anybody.
Indeed. Well, Katherine, thank you very much. It's been a pleasure.
Yes, thank you very much.
Well, it wasn't too painful, was it? It's quite easy on these podcasts. Quite enjoyable. Great stuff.
Thank you.
Brilliant. Pleasure.